Good afternoon or good evening. This is the time of day when you don't totally know. I'm Godefroy Beauvalet. I'm head of the AXA Research Fund, and I welcome you to this inaugurational event of the AXA-INSEAD Chair on Market Finance Risk. I'm going to leave this this podium very soon, and leave the floor to Gerald, Harlin, and then the other speakers for this introduction. I just want to say one word about today. You know that we are going to talk a lot about information on financial markets and the complex dance, waltz, salsa, hip-hop, I don't know, type of dance that information and price play together on these markets. And so a lot of the discussion will also be about new ways for information to circulate, social media, the internet, these kind of things. So I suggest we have an experiment tonight. You have 2 hashtags on Twitter to maybe tweet or read tweets about what's going to happen today. And I suggest we all try and make as much noise on the internet on this event as we can. I'll be back after our main speakers for the panel discussion, which I will be moderating. And so that's all I want to say at this point. I will now turn to Gerald Harlin. And who could be better suited to introduce these talks than Gerald, who is a member of the AXA Group Executive Committee and Chief Financial Officer of AXA Group since January 2010. He was previously, well, he was plenty of things, obviously, but notably Executive Vice President of Finance and Control in AXA, Corporate Treasurer, Head of Corporate Finance, Chief Financial Officer of AXA Asset Management Europe, and Managing Director of AXA Bank. He's joined AXA France as Chief Investment Officer in 1997 and has a career that makes him the most relevant person to introduce this new partnership between INSEAD and AXA. So thank you for being here tonight, and I'll now turn the floor to Gerald.
Ladies and gentlemen, I'm pleased to welcome you and honored to inaugurate the INSEAD Chair for Financial Market Risk in the presence of Claude Janssen, Honorary Chairman of INSEAD, and Peter Zemsky, INSEAD Interim Dean. As an insurer and asset manager, we know the value of informed risk-taking. We know progress exists, and solutions come about only by accepting confrontation with risks. The very nature of our business, protecting our clients, their families, and their goods against potential by uncertain risk, requires that we allocate time and resources to developing our knowledge and prevention of those risks. AXA decided to support fundamental research because it is a source of scientific progress and it challenges conventional ideas. This effort has a philanthropic logic, not only out of generosity, but also due to the belief that we have that preserving the independence of the researchers would stimulate their creativity, protect their credibility, and facilitate the sharing of their discoveries. Driven by this conviction, in 2007, AXA created the AXA Research Fund to support fundamental research on global risks that affect people and the planet. In 2013, AXA reinforced its support to the research fund by providing an additional 100 million euros to the 100 million euros initially granted. This is currently supporting 367 projects around the world on environment, human life, and socio-economic risks. By betting on the strong engine of scientific progress and the construction of long-term approaches based on a good understanding of the world and intelligent risk management, AXA hopes to contribute to a better future together. As AXA Group Chief Financial Officer, I believe that financial market risks are an important research subject for several reasons. First, information today travels at very high speed, making the financial system very reactive to any news or event, either financial or political. Second, the concentration of financial markets makes the system vulnerable to any unforeseen events. Forecasting ability is crucial to financial management. Then, financial markets are not immune from human irrationality, whether that irrationality is due to optimism, fear, greed, or other forces. Although prices impart the information with great efficiency, what the information tells us is that often the aggregate behavior of a crowd of investors is not rational. The investment managers need to be able to carefully react to market information and take the irrationality into account in the market communication. Last, we might not be able to forecast a future financial crisis, unfortunately, but monitoring the global concentration of the financial sector around a particular risk could provide us with indication on the nature of a potential risk. For all these reasons, ladies and gentlemen, we are very pleased to provide AXA Research Fund support to the prestigious INSEAD chair headed by Professor Joël Peress. Joël Peress' impressive work skills and innovative research will contribute to a thriving research program and will leverage the international network of excellence of INSEAD. I hand over to Claude Janssen, Honorary Chairman of INSEAD.
Ladies and gentlemen, thank you very much, Mr. Harlin. Thank you for these words, and congratulations to AXA for the support you provide to research in general and in so many far-reaching projects. It's a great honor for INSEAD to receive this chair. Many thanks to AXA Group and AXA Research Fund, particularly to Henri Cast for the decision to create this chair and for his message, which is in the folder, as well as to my friend Claude, with whom I had many conversations over time in the past on the subject of INSEAD. Because I must admit that we've thought of AXA for a long time as a future close friend of INSEAD. When coming here, I wondered when AXA was really, or the start of AXA really took place. And it happens that BBR started to build this group more or less at the same time when we started to build INSEAD. It's very interesting, this around 1960. That's about the time when he started AXA, and around General Doriot, small group with Olivier Giscard d'Estaing, who is there, and a few others. We started to think about making a business school in Europe that later became INSEAD 2 years later. We are particularly proud to be associated with AXA because AXA is a prominent insurance company, first in France, second in Europe, with one of the best known names in the world, as you said a bit earlier. And I wouldn't say that INSEAD is the best known world for business schools in the world, but because there are some older schools that are very well known, but it's very well known and it's very international, like INSEAD. As you know, we have campuses in France, in Singapore, in Abu Dhabi. We have 1,000 MBA students per year that come from 80 countries, 9,000 executives following executive courses who also come from many countries. The faculty is from 30 countries, the 145 professors. The 45 alumni live in 180 countries, almost everywhere in the world. And governing bodies like the board, the advisory council, are also completely international. So I don't want to draw a parallel between AXA and INSEAD, but it's two ventures that were started very small, in Normandy, I think, for AXA, in the forest of Fontainebleau, or in the castle, in fact, of Fontainebleau for INSEAD, and which each in its field grew to become a well-known entity. And this association to me has a particular sense, and I'm particularly happy of having it today. In philanthropic attitude like the one, initiative like the one you mentioned, shows great vision and foresight. You indeed, by supporting research in many ways, this is beneficial for the society as a whole, and I congratulate you and thank you for that. And I'm very delighted that this gift will reinforce the fruitful and mutually beneficial relationship between AXA and INSEAD. There are currently 35 alumni working in the group, AXA. About 100 members of the AXA staff have participated in various executive education programs, particularly 2 programs that were specially designed for AXA. One of our alumni at some point was member of the executive committee. Henri Castres came about 10 years ago at one of our international councils and delivered a very impressive speech, and AXA has for years supported us with the tax d'apprentissage. But receiving this chair donation from AXA is a vote of confidence on your part for the position of INSEAD as a top research institution. We started really in research very early, but we pushed research strongly starting roughly in 1995. That's when we developed the creation of chairs, the purpose of the chairs being to support research in various areas. We've created about 35 chairs in the last 20 years, and that has allowed us to develop research to a great extent. It's certainly one of the reasons why, and a lot of people don't know that, although we're a school and not a university, INSEAD appears in the famous Shanghai rankings as one of the very few institutions based in France, in the economic section. That's because we've been pushing research and are appreciated for the research we do. A chair allows faculty members, the faculty member who holds the chair, to do independent research and advanced knowledge in his field or her field of expertise. And the result of this research is taught in the classes, and participants apply it every day. And that's very useful to society, to the participants, and to INSEAD. So thank you again very much to AXA and AXA Research Fund for this very generous donation. I'd like also to extend my warm congratulations to our distinguished professor, Joël Peress, who will be the AXA shareholder. And I know that now, like all the shareholders in the faculty do, he'll write under his name AXA Professor. It's very important because it gives him a lot of weight, and it gives AXA some publicity, in fact, because they write a lot, the professors, you know. That's one of their businesses, to write. So that's it, and I'm now giving the stage to Peter Zemsky, who is the interim dean of INSEAD. He's also the dean for degree programs, has been previously dean of the faculty, and as such has been working very closely with the faculty. He's been a member of our faculty since 1994, after obtaining his PhD from Stanford. He's professor of strategy, and he holds a chair, which is the Eli Lilly Chair in Strategy and Innovation. And I'm very pleased that Joël Peress will now be in the very strong and respected list of shareholders at INSEAD. Thank you again to AXA Research Fund, and Peter, it's yours. Thank you. I'm careful when I go down steps because I fell down in the spring and broke my back. So I don't want to do it again.
Yes, thank you, Claude. As you go down the stairs, it reminds us that risk is everywhere, and no more aware of that today. So let me just, of course, start by adding to Claude's thanks to AXA and to the AXA Research Fund for this very generous support. It's just a great pleasure to be here with you all today, and I think there are really two things that make it just great. One is there's no greater honor for a scholar than to receive a chair. We very much It's a profession where you work hard and often alone or with one or two co-authors. And to work up this ladder from assistant to associate to full, and ultimately, hopefully for a few, a chair. And so it's really just great to be here to honor my colleague Joel. His family's here. It's just a great moment for him as actually a relatively young scholar to have achieved this. And secondly, it's great to be here because of the way AXA has implemented their chairs. I think these chairs really stand out for the rigor at which you just bestow them. So you're really, it's a vote of confidence in Joel, but also in the whole INSEAD and the finance department. So I thought I would just talk a little bit before I talk about Joel, also about the finance area that you're also backing with this. So as Claude says, INSEAD over the last 15 to 20 years has made a big push in building up a strong research faculty. And although, INSEAD, for those who know us well, are often known for general management and leadership and strategy, we have invested across the academic areas. In particular, finance has been a big area for us. We have almost 20 academics, like usual, from INSEAD coming from all over the world, but also all of them having PhDs from top schools in the US or Europe. We have 5 other chairs that we've received in this area from areas like investment banking, asset management, international finance. But it's just really great to have, especially in this day and age, to be reinforced with a chair around risk is tremendous for us, and we're, as I said, just very grateful. One of the tests of a school's research ability is the ability to train PhDs. Just as AXA is giving back by having this research fund, a university or business school gives back by training PhDs, which for the most part go to other schools. And one of the things we're very proud of is we really have one of the very top PhD programs outside of the US, one of the few non-US schools that places our PhD students at places like Harvard and Wharton and Chicago. And the finance area is currently, I think, has about 20 young PhDs that Joel and others are working with. I should mention Joel for many years led our PhD in finance in that area. Again, the finance area, very strong. We have, if you look at productivity in finance professors over the last 10 years, Professor Massimo Massa in the area is certainly among the top 5 in that area. And across Europe, if you were looking at sort of top 15 scholars in Europe, we would certainly have at least 3 of those. The area turns out regularly lots of A-journal publications and garners many rewards, which leads me to Joël, stands out. In particular, for those who know the field of finance, one of probably the preeminent journal is the Journal of Finance. And it's a big thing for all scholars all over the world are competing to publish in that journal. And then on top of that, at the end of every year, they look at the articles that have been published and they recognize the very best amongst those. And they reward something called the Smith-Breeden Prize to those articles. And it's a big deal for a finance professor to win that even once. And Joel, even at this mid-career, has won it twice. And that's a huge testament to his abilities. We'll hear from him shortly about what he's working on, what he's thinking about, his contributions. The one thing I would just highlight when I think about Joel's work is we know finance has been a really, really important discipline for social sciences and business, in part because of the quality of the data is amazing. But in this day and age, we know, this whole big data, there's a lot of data out there. And so one of the many things that Joel does well is he links some of this rich data in terms of all the media that's happening out there with and the information in that with financial markets. And clearly that's just very path-breaking and important. The other thing I would highlight about Joel's work is finance, again, very, very demanding field, probably in a business school the most demanding, and there people usually specialize in either empirical work or theoretical work, and it's quite challenging to publish in both, but Joel does that, and that's something, again, that helped him step out and helped him win this award for the school. The last thing I would just talk about is Joël, just if you haven't looked yet. Again, PhD from the University of Chicago, has spent time as visiting scholar at the London School of Economics, at Princeton, where he was a visiting scholar. That's great, but I think what I'm most proud is that for most of his career coming out of his PhD, he was nurtured by the environment at INSEAD, and Joël, we're just very, very proud to what you've achieved and what you have in front of you. So without further ado, it's my pleasure to introduce to you the new AXA-INSEAD Chairholder in Financial Market Risk, Joël Peress.
So good evening. I'd like to start with some thanks. Thanks first to the AXA Research Fund and its head, Godefroy Beauvalet, for endowing the chair. It's an honor for INSEAD and for me to have been chosen after such a rigorous process. The chair will provide the resources I need to conduct my research. Thanks to my colleagues at INSEAD, the research I've done over the past 12 years owes much to the many stimulating conversations we've had together over time. I'd like also to thank the panelists for agreeing to take part in the event, especially Professor Guizot, who flew in from Rome. And then finally, last but not least, I'd like to thank you, the audience, for coming this evening. So I'll tell you about my research. Research in finance is often quite technical, with many sophisticated mathematical formulas. Here's a sample of what you could find in finance journals. Some colleagues in the room will recognize some of their own equations. I'm guilty myself of some of these. But I'd like you to enjoy this evening, so relax. I'll stay away from any fancy mathematical modeling. I'll simply assume that you're not finance experts. Okay, so sorry to those who actually are. Let me begin with some background. A good starting point is the debate on market efficiency. The notion that markets are efficient have had a huge influence on academic research, but also on the real world, shaping the financial industry, financial regulation, and monetary policy. Though the theory has been challenged by academics over the past 2 decades, as well as by major crises, it has proved extremely resilient. So what does market efficiency mean? Market efficiency means that prices of assets incorporate all available information about their underlying value. The success of this simple theory owes a lot to its remarkable ability to describe in a very parsimonious way a wide range of patterns observed in financial markets. Above all, it predicts that asset returns are to a large extent unpredictable. Indeed, the hypothesis is closely related to the notion of random walk, according to which price changes represent random departure from previous prices. Here's an illustration of several random walks. The idea is that in the absence of any friction or barrier to trade, agents will trade on the information until it is capitalized in prices. If, for example, a trader knows that the price of an asset will rise tomorrow, he will buy the asset today, push up its price, thereby incorporating the information into the price. Since news is by definition unpredictable, resulting price changes must also be unpredictable. To be more precise, the efficient market hypothesis allows returns to display a limited degree of predictability. They may be predictable, but only based on measures of their riskiness, such as what specialists call their beta, which captures systematic risk. The idea is that risk commands a risk premium, and this risk premium imposes a trend on stock prices. Therefore, much of the debate on the efficiency of markets revolves around defining risk. This process of incorporation of information into asset prices implies that prices are the best available estimates of underlying values of assets. To be clear, the hypothesis does not claim that these prices are always right. only that they summarize accurately the state of knowledge at a given point in time. You can see why this hypothesis has encouraged the development of low-cost index tracker funds, an important positive development for the industry. On the negative side, why it has led central banks to let asset bubbles inflate. Since I'll be focusing much of my talk on asset prices, I should emphasize, before we move on, that assets are not just lottery tickets or horses in a race. They matter to the real economy because they determine investments. A sector or a firm with a high stock price will experience an inflow of capital, which would fund its real physical investments. Think, for example, of a firm issuing shares to buy new equipment or to finance an acquisition. So how well does the market efficiency hypothesis perform? In fact, pretty well. Empirically, asset markets behave in a way that, by and large, resemble a random walk, in line with the hypothesis. Asset returns turn out to be extremely difficult to predict. Here's a chart showing how the CAC 40 performed recently. It does seem to follow a random walk. But the hypothesis has been criticized by statisticians who have uncovered a number of predictable patterns labeled anomalies. Some anomalies have been dismissed without too much difficulty, while others are still challenging the hypothesis. Calendar effects are an example of the less serious anomalies. Stock returns appear to display regular patterns, such as a tendency to weaken at the start of the week, the so-called Monday effect, or at the turn of the year, the January effect. But these patterns have shrunk significantly or even disappeared soon after they've discovered. This is precisely what the efficient market hypothesis would predict. Smart investors who learn about an anomaly trade on it, that is, they buy stocks when they're cheap on a Monday or in January, thereby reducing or even eliminating this effect. As a matter of fact, this is an aspect of finance I find fascinating. Theories and empirical patterns don't last. Once discovered, once economic agents become aware of them, they change their behavior, and these patterns tend to disappear, more or less quickly, making the theories obsolete. So we, researchers, are left chasing a never-changing reality. A more troubling anomaly is momentum. That's the tendency for assets that have recently outperformed to continue to outperform. This effect is big. It has been observed consistently over most time periods across many countries and asset classes, and it shows no sign of fading away. Momentum returns can be reconciled with the efficient market hypothesis if risk changes. The puzzle is that the hypothesis requires risk to increase following positive returns and to decrease following negative returns. In reality, the exact opposite pattern happens. So moving away from stock prices, the efficient market view also has a difficult time explaining the intensity of trading observed in financial markets around the world. For example, the share turnover on European and American stock markets is of the order of magnitude of 100%, meaning that the entire stock market value of a typical firm changes hands every year. In an efficient market, trading is mostly motivated by portfolio rebalancing and liquidity needs, since much information is conveyed by asset prices, leaving little scope for disagreement between traders. But it's difficult to believe that these needs are of the proper order of magnitude. So motivated by these anomalies, academics have led attacks against the efficient market theory from two angles. The first line of attack comes from skepticism about agents' rationality and their assumed unlimited computational capabilities. Behavioral economists who apply insights from psychology to finance argue that human beings, far from being rational, are subject to a host of biases. For example, they display excessive confidence in their own abilities, tend to extrapolate recent events into the future, or are more willing to realize profits than to cut their losses. Combinations of such biases on the large scale may lead assets to be mispriced. The second line of criticism, to which I belong, does not depart from the assumption of rationality. Instead, It argues that markets are full of frictions that prevent rational investors from implementing the trades that would allow information to get into prices. Examples of such frictions include limited access to capital, short selling constraints, liquidity, and, the focus of my research, frictions due to information. So here are the kind of questions that I study. What factors determine how much information about assets is produced? How fast and through what channels does this information diffuse? How is information incorporated into asset prices? What are the consequences of information asymmetries? That is, when some traders know less than others and are aware of their disadvantage. What are the implications for the real economy? How do economic agents at large use information reflected in asset prices? These questions have much to do with the efficient market debate. They seek to understand to what degree and under what conditions asset prices are informative, and therefore when they can be used as a guide and when they should be treated with suspicion. A major challenge for theories of information is that, these theories cannot be tested, since information is not observable. Who knows what people are thinking? Even if agents were asked what they think of various assets, it's not clear that their response would correlate with their actions, because the mere act of interviewing can disturb the interviewee. This is precisely why I believe that theoretical modeling is so important. In my opinion, the only way to bring information-based theories to the data is to microfound them. That is, to use economic theory to connect information to observable variables. At one end of the chain, one could look for observable factors that shape investors' incentives to collect information. For example, one could think of investor characteristics such as their wealth or occupation, features of the asset such as its size, risk, or business. At the other end of the chain, we could look for the impact of information on observable aspects of the economy. For example, how volatile are stock returns? How dispersed are analyst forecasts? What kind of investments is the firm making? And so on. Thus, modeling information as a rational choice allows us to relate observables to observables and thus to test information theories. I'd like to illustrate this methodological point with one example drawn from my work. Are stocks held by more investors more efficiently priced? This question is important, both for companies and for policy makers who often take actions to promote a broad equity base. The answer should clearly be yes if each investor produces a fixed amount of information, independent of the number of investors in the company. But it's no longer clear-cut if this amount declines with the number of stockholders. Departing slightly from traditional theory, I showed that the trade-off exists between the number of shareholders and their research effort. In a nutshell, the wider the investor base, the smaller the risk borne by each investor, and the less valuable information. So a more widely held stock can actually be less closely followed, leading to less informative prices. The model yields predictions consistent with existing evidence, as well as new applications that can be tested directly, for example, relating the size of the shareholder base to trading volume. So I'd like to spend the remaining time on the questions on which I will focus in the years to come. How does information diffuse through the economy? In contrast to the efficient market theory, the frictions approach recognizes that public information does not reach all corners of the investor population instantly, but instead diffuses gradually. This notion can help resolve some of the puzzles that challenge the efficient market hypothesis. Go back to the momentum effect. Returns will display momentum if investors slowly adjust their opinions to fresh information. Consider now the enormous volume of stock trading observed around the world. If investors don't share the same information, then they will have more reasons to trade. What role does the mass media play in the diffusion of information? There's none, according to the efficient market theory. They are only a sideshow, News is incorporated into prices as soon as it is made public, even before the media have time to print it or broadcast it. Even if most investors do not pay attention to this information, the few who do will ensure, by trading on it, that it is immediately reflected into prices. On the other hand, if frictions are severe, the media may help propagate information across the public, reach investors with no other access to news, or draw investors' attention to specific events. In doing so, it may contribute to the efficiency of markets. Let me show you a recent example involving a popular social network, Twitter. Last April, a tweet from the Associated Press reported that explosions at the White House had injured Barack Obama. Here's a snapshot from that tweet. So don't worry, you didn't miss out on any major news. This never really happened, and Obama's fine. This was a false tweet sent by hackers belonging to the Syrian Electronic Army. Within a few minutes, the tweet was corrected. What is interesting in this story is the stock market reaction. There was panic selling for 2 minutes. The S&P dropped by a percentage point, the 10-year Treasury bond by 10%, while gold appreciated. Within 5 minutes, the market had fully recovered. Okay? So this chart shows the S&P 500 reaction within the day. Okay? So the blip is when the tweet was publicized and the following correction. This second chart zooms on the minutes surrounding the event. To me, this episode is interesting on several accounts. First, it illustrates how advances in information and communications technology, the internet, social media, electronic filings, and so on, allow information to propagate much faster than in the past. Investors, both institutional and retail, have access to news in real time and at low cost. Second, the Twitter story is a good illustration of market efficiency. It was rational for the market to respond in that way to the news, given the credibility of the source, and it was rational, again, for the market to correct its response. But it also raises questions about the influence of the media, both old and new, on financial markets. Anecdotal evidence suggests this response is not always consistent with rationality, and here much work is needed to understand this influence. On the theoretical side, models of the mass media are still in their infancy. Empirically, a causal link from the media to financial markets is difficult to clearly establish. The Twitter episode is a beautiful example of what economists call a natural experiment. Take a shock to the media, a shock that is sudden and doesn't originate in the market, and watch how the market behaves. In practice, such experiments are rare, so researchers tend to document simple correlations. But these correlations may reflect an omitted variable. Both the media and the market may respond to fundamental news without being directly related. Or they may reflect reverse causality. The media may report important market events. So careful work is still needed to assess any impact of the media on markets. Finally, there's a third interesting aspect to the Twitter story. The speed of the response is stunning and revealing of a kind of hyper-efficiency. A hyper-efficiency that in fact is a bit worrying, in that it does not seem human. Many experts believe that the selling must have been triggered by computers. Computer programs automatically scan news feeds looking for keywords. Here, the fatal combinations of the words explosion, White House, Obama triggered the sell orders. So what is the impact of high-frequency trading on financial markets? These traders use sophisticated algorithms and super-fast computers to detect and exploit market movements. They execute trades at mind-boggling speeds, at milliseconds and faster. I don't have time to elaborate on this new development, which is raising many questions. We may talk about this later in the roundtable. I'd like to conclude by emphasizing the importance of a different kind of information. Information about investors rather than about assets. Information that that documents stockholders, their portfolio positions, their opinions, and so on, rather than information about a firm's cash flows. Consider an investor who realizes before most that an asset is undervalued. He purchases the asset on the cheap with the hope of selling it later for a profit. Suppose that this investor has a short horizon, for example, because there's a chance that he will need money soon. In such a situation, the investor doesn't care that much about the asset's true fundamental value. That is, the stream of cash flows the asset will produce up to terminal date. He's more interested in the price at which he can sell the asset on the day he needs the money. This price, in turn, depends on other investors' opinions of the asset's fundamental value. Thus, the risk for the agent is to be forced to sell the asset before the market comes to realize its true value. This example illustrates that fluctuations in average investors are holding the same asset in case these other investors need to sell prematurely. Indeed, an early sale by a block of short horizon investors may depress the stock price and hurt our investors if he, too, has to sell early. What this story illustrates is the importance of information about other investors' positions and strategies, especially when they have similar portfolios and use similar trading models. If, for instance, the model recommends selling some assets, then they will all sell, driving prices down and triggering further model-driven selling. Technological progress makes it now possible to store and analyze data on investors' asset holdings, in particular those of financial institutions. These data are essential to regulators and central bankers for managing the financial system, given its growing complexity. But it's not clear, however, whether and how such data should be made public. In complex systems with multiple feedback loops, disclosing information may have many unforeseen consequences. Assuming it is beneficial to release the data, there are many difficult questions regarding the frequency at which they should be collected and made available, the timeliness of their release, their level of detail, and whether information should be kept anonymous. I'll end here. There are many other issues we could discuss. It's an exciting adventure. I'll keep you posted. Thank you.
Thank you very much, Joël, for this very interesting talk. And I propose that we now go on. And as was mentioned by Gerald Harlin before, the AXA Research Fund funds 367 teams. And I wish for this panel discussion to show that this is actually a community of research that we are trying to build. So I'll ask Professor Luigi Ghiso from the Economic Institute of the Einaudi Foundation in Rome to join us. And Professor Ghiso holds the AXA Chair on Household Finance. So this is a case in which we have economists and financial researchers that happen to work together before they were both AXA chairs. So we reunite them through the AXA chairmanship. And this community of interest and expertise also involves AXA practitioners and experts who are active on the trenches, as you mentioned before, of these financial markets. So I'll ask Emmanuel Touzeau, who is head of communications and corporate responsibility of AXA, and worked a lot on the financial communication of the group, to join us for this panel discussion. And what I propose is we dig a little deeper in some of the very exciting issues that Joël mentioned on the life cycle of information on markets, on the role of the media, and the role of technology on these on financial markets. But mainly, after a few rounds of questions, I will open the floor to the audience, and you'll have the opportunity to contribute, ask any questions, or add any comment. We have many experts on these issues in the room, so that's what we'll try to do before we all go to the cocktail. But maybe a first question for Professor Guizot would be, as Joël mentioned, he is not questioning the rationality hypothesis on of the actors on the market. And part of your role has been to explore, are actors on market rational when they deal with information? Can they be biased, influenced? Can their rationality be tricked? How can you model that? How would you react to this type of questions?
Thanks a lot, and good afternoon. Let me, before trying to address the question, first of all, to congratulate with Joël. He's first of all a colleague, he's also a friend, and I've been following him and his research since the very incipit when he graduated from Chicago. And actually, I also relied on some of his papers in my own research, so he acted as an input. And one of the first papers, which was one of his thesis paper, was precisely on the topics that we are discussing today, on information gathering by individual investors and the consequences that these differential incentives that individuals may have to collect information, to invest in collecting financial information, may have on observables. And then it was showing that because people have different incentives to gather information, his model was a fully rational model. The only friction was the fact that information is costly. It's not cheap, and we know that. If you want to become informed, you have to spend some time in doing it. But then, it was showing that wealthier individuals have stronger incentives to collect financial information because they are financially more informed. They can achieve better portfolio performances. And so, you can see what the kind of implications that this can have. Then I was using this framework and tried to provide some empirical evidence, and actually I was able to sort of confirm what his theories were predicting. I was documenting that I was collecting data on how much time people spend in gathering financial information, and showing that the wealthier people, they do spend much more time in collecting information, and also those who are more risk tolerant, people that can bear risk more, they collect more information. That was another prediction of Joël's model. And the reason is very simple, that if you are very risk tolerant, you invest more in stocks. Stocks are information intensive, so you spend more time in gathering information. So, that was a rational type of model. The second part is if you have more information, then you should be better able to achieve better portfolio returns, more efficient portfolios. That was the second implication of Joël's model. On that, I sort of got a kind of mixed result. It's much more difficult to prove whether you are able to extract something from the information that you have. And that leads to the second issue. In general, is more information good? Is more information bad? Here, things are much more blurred. So that was a great paper. And I wish that it would have been published in an even better journal. It was published in a great journal, but would have deserved to go in a top journal in my view. Now, coming to your question about rationality, I think you are asking the $10 million question. I have no answer, but I share more. There are essentially two big divides in the debate. That is. Restless is going on. I don't think that we'll find a solution for several years to go. But essentially, the divide is there between those who think that people are kind of fully biased, they make a lot of persistent mistakes and never correct them, and others that think that you can explain, the other extreme people that think that you're always doing the best that you can. My view is that human beings are not perfect machines. I mean, but at the same time, once you give them enough incentives, they do the best that they can. I think that human beings are optimizers. They are maximizers. I think it's kind of intrinsic in human nature to try to be cost minimizer. Let me give you just one example. Think of when you want to enter a door through a system of revolving doors. What I notice is that sometimes we speed up to enter the door as soon as we see that somebody is pushing the door, because we want to take advantage of the fact that somebody else is pushing the door, so we want to save on the cost of pushing. That is a kind of reflection that we have, we want to minimize spending some effort in pushing the door. And I think that human beings, in a deep sense, we are optimizers. Then we make lots of mistakes. We correct the mistakes. There are also examples that seemingly appear to be kind of irrational, or at least have been cited as being kind of evidence of irrationality. Let give you one from finance. For instance, some people have been arguing that individuals at the same time they have debt and a lot of cash in their checking account. Like you have a mortgage, and at the same time you have 20,000, 25,000 euros in your checking account. This has been argued is a kind of, a symptom of irrationality because on the debt you pay 4, 5, 6%. On the checking account you get nothing. So the best thing to do would be, if you want to save money, to transfer and prepay the mortgage. That is okay, but if you value liquidity, and we do value liquidity, people attach a lot of value to liquidity, I think you can rationalize the simultaneous presence of debt and checking account, money in the checking account. So my view is that with enough frictions, I think you can, in several instances, you can rationalize what people do. And at the same time, I think that there are symptoms of the typical description that appears in standard financial models of an individual that is a perfect machine that is maximizing those formulas that Joël was showing. I think is a kind of poor description of people's mind. So I believe that people have sentiments, they feel fear, sometimes they're pessimistic and so on. Okay.
Thank you very much. And this idea leads me to go to the practitioner here and to Emmanuel, because if there is room for emotions and psychology on the market, then there might be also strategic management of information by the actors. So I wonder what is your experience when it comes to looking at what is essential for the market players and what type of information do they react to? Actually, I can keep the mic. You are
okay,
mic'd.
I have a mic. Yes, well, first, we are trying to do our best, and those questions asked by Joël are kind of exciting if we know the answer, but a bit scary when we know them because it may change the way we manage information within the companies. For a listed group like AXA, we're doing our best to share with the market, with market participants, what we believe is the most important, the material information to better understand and assess the performance of the group. I can tell you, and I'm sure Gerald would confirm, in a company the size of AXA, we could flow the market with number, and we have a role in deciding what is material and what's not. I think one easy way, and what the financial communication of AXA has been doing for many years, is just use and publish and share the information the management team is using to manage the company. I would say this link between internal management and communication is one simple way of trying to make the link and sharing useful information. That being said, it's not the guarantee, and time changes. I mean, if you look at take our full year 2006 earnings presentation to analysts and investors. On some slide at the end of the deck, you will find a pie chart with our investments, and maybe one small slide with our exposure to mortgage-backed securities. A year later, this piece of information, it was, I don't remember exactly, Gerald, 10 slides, 15 slides in the presentation. And because we were in the full of the subprime crisis, and we had the information before, but it was not published. And a year later, it was almost at the core of the presentation and of the information we were sharing. So if we knew, should we have published it a year before, or was it the right way of doing it, or did we publish too much? You never know. We're doing our best, and that's the, I would say, permanent management of information and what we share. And then there is the question of with whom are we sharing this information? We're talking to investors, we're talking to the press, we're talking to analysts, and how do we dedicate our time? How do we dedicate management time? Is it the most efficient use of this time, of this? There again, there is market practice, trying to do our best, but those are questions, and I think every company asks itself, listed company, are we doing it in the most efficient manner? And I would say there is the one last dimension is there is the thing that we control, information, the way we share it, and everything we do not control. And we've seen that, especially since the beginning of the crisis. Sometimes you're doing your best, and you discover that the level of the 10-year interest rates in the US may be more important than all the information, however good and reliable it is, that you can share with your company. So we're permanently balanced between trying to give the best possible information, the most appropriate one, the most material one, and in a world where sometimes market forces are stronger and information from the outside are stronger than ourselves. So that's the challenge of the strategic management of information for us.
Yes. It is interesting also because maybe if you had published the 15 slides in 2006, then the markets would have asked for more in-depth information anyway, so you would have ended up with a 15 squared, 200 slides on the
That's
next
possible.
year. Maybe, Joël, you wanted to react to
Just
that.
on the idea of active management of information by firms, there's evidence that firms that do an acquisition, and when they pay with their own stock, so not the cash acquisition, but the stock acquisition, attempt to manipulate their stock price during the private negotiation period. So when there's a fixed dollar amount that's been agreed to, they try to push the stock price up in order to issue fewer shares to the target shareholders. And it does, what the numbers show is that it actually does work. That prices appreciate during that period of time, and after this they stop and the prices revert to what they were before. So maybe it's good news.
Depending on which side you are.
Okay. Joël, on this issue of anticipations of actors, there is another very interesting natural experiment in a way that happened on what is the information, the indicator that is valued by the market. And I'm thinking at an example that Eric Chanet often uses of the sustainability of government debt that was normally captured by the interest rates or price of government bonds, and suddenly during the crisis in 2008, it diverged, meaning that the market revised strongly its views on the importance of that indicator. How does that happen to be sudden? How does the coordination of anticipation happen on markets?
I guess this is the second $10 million question you're asking tonight.
I'm going to be either very rich or very poor today.
You're raising fundamental questions about coordinations of expectations and actions between economic agents. We don't know that much about this. If you think about the bubble, say the tech bubble, many experts felt that we were in the middle of a bubble, but the big question was when to attack the bubble, when to start selling. If you attack too early, you would lose a lot of money. If you attack too late, after the bubble had burst, you lose a lot of money. So it's really a clock game, and we don't really know that much about this. There seems to be a tipping point after which people receive decide that they're going to go against, say, a bubble. Maybe the media plays a role in determining that tipping point. That's my impression. I have no evidence to back it up. It's just sort of casual impression. My impression is that the media sort of plays a role in coordinating beliefs, in making everybody know not so much what the true fundamental value of assets are, but rather informing the public about what the public actually believes. Once the information gets into the media, it becomes common knowledge that this is a bubble. And then it opens the door, the gate for the barbarians to come in and to start attacking and selling the assets. So this, it's a good question. We know very little about it. There's a branch of game theory called global games, that studies global games, that tries to make progress on this, but this is still very abstract and difficult to bring to the data. So more work is expected there.
Okay. You mentioned the media, and maybe we should turn to that. And one of your very exciting work was to create to make observable the role of the media on some on a specific market. So maybe you should, this is time for you to explain us this very interesting observation you made.
Yeah, so, I mentioned in the speech that one of the important challenges for assessing the impact of the media is to pin down a causal effect of the media when you look at empirical questions. So you look for natural experiments, for example, the tweet episode. In a paper, I've used with the objective it was to assess the impact of the media on financial markets. I've used as a natural experiment labor strikes in newspapers. So I've gathered data on industrial actions in newspapers across the Western world, essentially. So I was looking for nationwide newspaper strikes. And actually on this, France is doing really well. So France and Italy actually were some of the bigger countries in the sample.
Yeah, we contribute to research.
So in Italy, one of the reasons why newspapers were going on strike was to fight censorship and rules that have been enacted by Berlusconi, which were perceived by journalists as infringing on the freedom of the press. But the point is that by looking at these events and looking at how the market reacts on these events, you can get a sense of the impact, the causal impact of the press on the financial markets. So what I found is that when newspapers go on strike, the level of stock returns doesn't change. The viability doesn't really change. But what changes is trading volume. Trading volume goes down by 10 to 12% on newspaper strike days. The stock returns are less dispersed. That is, they move more in sync. And these effects are particularly strong for small stocks. So these are the stocks that tend to be held by retail investors. I also find that the way returns evolve over time is also is very special. If there's a strike on a Wednesday, then the news that comes out on the Tuesday does not get published in the newspaper, Wednesday newspaper, so it doesn't materialize in stock prices on Wednesday, but then eventually it hits stock prices on Thursday. So you can track the flow of information. So the conclusion of the analysis is that actually the media have a causal impact on markets. It's somewhat subtle. It affects volume. It affects the autocorrelation of returns, and it seems to be more important for smaller stocks, those that are held by retail investors, presumably one may suspect.
Okay. Professor Guizot, you've also worked on the role of advice and media and how you compute information that you get on a stock or on a class of asset. And when we prepared, you were telling me that you felt that the way we are influenced by the news that we get, the information that we get, is not something that is like, oh, I have this information, I compute it, that makes me change my price target for this specific stock. So how would you describe this process of how people are computing the information they get from media?
I think, the level of individual investors, first of all, individuals use the media as a prominent source of information, of financial information. So, if you look at where individuals get information in order to make their financial decisions, the primary source is clearly the intermediary. As much as many other markets, like if you want to buy meat, you go to the butcher, and you ask the butcher, which is the best meat that I can get today, given what you want to do. The same is true in financial markets. So you go to the intermediary and ask, present your needs and ask him for financial advice. The second source is the media. So there is one channel which is active, where individuals, they spend time reading newspapers, sometimes generic newspapers, the general press, sometimes a financial piece of information, like the Financial Times. Or they can go surfing the internet, searching for guidance. And this is a kind of active role that they have. But my impression is that, and this applies all the things that Joël was saying about the role of the media in conveying public information. The media do not reveal private, specific information that goes to a single trader. They reveal information that is available to the general public, because once it goes to the media, essentially everyone in principle knows. But there are some people that they know later. Some others, don't get the information immediately because they are not paying attention to that specific newspaper and so on. But I think there is also another role which is at least as important, and it's the fact that there is a kind of involuntary information channel through the media that act in the background. And this is true for, in particular, the TV and the radio. When you're traveling and you're driving your car with the radio switched on the financial channel, you're not paying attention. So you are kind of thinking about something else, but you are filtering all this information. That is a kind of more gradual process. And that is harder to think of what is the influence, what sort of impact is going to have on the decisions and the choices of these individuals, but could be even more penetrating than when they pay attention selectively to a piece of information. Just a simple note on what Joël was saying. It seems that he has discovered, he's the only one that has discovered that Berlusconi did something useful. So was assisting to achieve identification in a kind of empirical test.
Thank you for that. Emmanuel, I would like to zoom on, we said that when something is on the media, it's pretty much common knowledge. But let's zoom on the few hours when there is, for instance, the results day, and how does this information become common knowledge? I understand that there are the few first minutes and the press wires, then how the journalists will play it out with their titles. How does that move?
Yeah, it's interesting what you said on the influence of media on the markets, because sometimes it's empirical evidence, but we see it the other way around, seen from the company. So on the day we release earnings results, we wake up quite early. We publish most of the time at 7 a.m. because markets are closed, so leaving time for market participants to understand and build an opinion on what we've just published. There are only a couple of people who don't spend time trying to understand and build an opinion on what we've just released. Several pages, 20 pages, 30 pages of information, is the newswires, Bloomberg, Dow Jones, Reuters. They are in a race to publish something as quickly as possible. So they are measured against each other. So at 7 a.m. sharp, they want to be the first one by the second to release something. So it gives a first general opinion because we release many pages. They send a small release, so it's easier for everyone. And I would say it's the first flow of information. And then I would say the days, hours go by, and the markets open at 9 in Paris, and there is the first market reaction. And on the good days, it's up. On the more difficult days, sometimes it's down for good and bad reasons. And what we see is that the way the markets open don't tell you how they will close at the end of the day, because sometimes your performance is difficult to read because there is a number of exceptional items. That's why through the day, the investor relations team, the management team talk to investors, talk to analysts, and you see the share price evolving through the day. And it's especially now that most newspapers now publish their paper online and update it through the day. You can see the influence of the market reaction of the share price on the tone of the article. If you open sharply down, for instance, your results will be obviously really bad in the article. And if suddenly, through the day, the market recovers because market participants believe those results are in the end pretty good, you will see that the update of on Le Figaro, Le Monde, the Financial Times.com, you will see the article, the tone of the articles being much nicer, and in a way, not always, but the market reaction and the share price is an information that feeds the media. At least for I mean, that's the experience we've been living here at AXA.
Okay. Before we open questions to the audience, I'd like Joël maybe to turn to the topic of social media, and you showed us a Twitter story, but that was a Twitter story of Associated Press has something like 2 million followers, and talking about Barack Obama, so it's a very macro thing. So I was wondering whether this is the potential disruption or the disturbance of markets through Twitter or other social media is only happening for this very core of accounts, or are we in a kind of a Warholian world where everyone can be an influencer for 15 minutes by saying something really shockful, a blunder by someone from a company that suddenly buzzes very fast? Is this something that we can see, or is this something that focuses on the main players at this point?
Yeah. Good question. I don't know.
Okay, that's time to go to go to the audience.
We don't have the data really and the perspective yet. So we have some events with the major social networks, but on the smaller ones at this point, I don't think we have enough data to come to a conclusion on this.
Okay. So this would be a good time to turn to the audience. If any of you want to comment or have a question, there's supposed to be a mic in the audience. It's there. Amandine
Thanks.
Soulier.
Hello, Amandine Soulier, Group Corporate Responsibility at AXA. I had a question regarding the analysis of how people or financial analysts will screen information depending on their background and their vision of companies. I mean, in political science, we learn that political information, economic information about society will be screened based on our beliefs and will have impact on our judgments. So I wanted to know, how do you integrate these psychological aspects of perception of information in your study?
That's a good question. And again, I'm going to hide behind I'm going to escape and hide behind the issue that we don't have the data. If we had a comprehensive database that showed at least some proxies for what analysts believe and so on, we could try and correlate this with the recommendations and earnings forecasts and so on. But unfortunately, we don't. We can go as far as tracking their performance, what's their track record, are they a star analyst or not. We can go as far as building networks between analysts and companies, so CEOs. Did you go to INSEAD as an analyst? You're an analyst went to INSEAD. Did the CEO of the firm you're following also go to INSEAD? So these kind of networks, we see they have an influence on the accuracy of forecasts, but beliefs and values, not. I don't think we have anything on this. Maybe, Touzeau, you worked a bit on this kind of questions.
I think, essentially your question is the following, if I can put in a format where I feel sort of more comfortable. That different people can read the same piece of information in a different way. You know, there is, let's say, a newspaper, that you read the headlines and 1,000 people are reading it and they give a different interpretation. I think on this, and this different interpretation is linked to their deeper beliefs and views, including different political views or ideological views. And in turn, this can have effect on financial trades. My impression is that this is reasonable. For instance, just to give an example, after the attack to the Twin Towers in 2011, there was a survey that was run in the Arabic countries, and 95% of the individuals were denying that the attack took place. Okay. Now, that was a fact, and the interpretation that they were provided, everything is faked, is made up by the CIA. Now, the CIA, makes up a lot of stuff, but they didn't make up them. Now, clearly, if you trade on that piece of information, that can have very different effects depending on your political views. Now, this is an extreme example, but my impression is that the way you read the news is not independent on the way you perceive and interpret the world, and your background, your values, your beliefs, including your political orientation.
Thank you.
Denis Duverne, second row. It's coming from behind.
Good evening. Short selling has been a fairly controversial topic during the financial crisis and has been banned on a number of occasions by regulators around the globe. What are your observations? And there are two theories about short selling. One is it provides liquidity to the market and it's good. The other one, it's just a source of profit for the bad guys. What's your, I would say, scientific view on short selling?
So I haven't done any research myself. I didn't look at the data myself, but the papers I've consulted on the question seem to suggest that short selling bans are harmful. So if you ban short selling of banks, the people who would like to sell because they don't believe in the future of the banks are prevented from doing so. But as soon as you lift the short sell ban, then the prices will collapse and eventually reach the low level that was justified by fundamentals. So I think the short selling ban seems to delay the incorporation of bad information into stock prices, and that's all. It doesn't stop the news from flowing. So my impression is that they don't really help in these instances. It's quite a controversial question. So maybe
it doesn't seem that controversial within the economist research realm, from what you said, Professor?
I share Joël's view. My impression is that, but I mean, our views probably are correlated. So in order to get a different view, I think you need a different sample, probably. We had a discussion during the crisis, precisely, it was, short selling was banned on certain days when, they said there was excessive trading, but the feeling was that they were killing the liquidity of the market. And my impression is that the harm that was provoking was exceeding the benefit. But, I think you need really a different sample, another view, for a person that has a strong opinion on the opposite side.
Okay, thank you very much. Do we have other questions? Edouard de Bonneuil.
Hello. Edouard de Bonneuil from AXA France. Many people perceive the current financial markets as a dangerous machine. Sometimes some countries are in big difficulties because the price of wheat is low or high, and many people can suffer or even sometimes die from it. And also sometimes companies are short-sighted and they don't invest in their main goals for the economic and the societal profits for the long term because the economy is crazy. And do you think that your research could do some good in those respects by changing the world in a way, by finding what kind of information should be disclosed or not disclosed for the market to better react and to be somehow more human, because most people don't know what it means to be human when they are in the market. But if we know the rules, then maybe we can make it better. Thank you.
Okay.
I feel the issues you're raising, which are interesting issues, have more to do with financial education in general than really about the type of information we want to disclose in the market. I think they reveal that there's a really poor understanding of the way financial market function, just among us, among the population. So, for example, when you alluded to wheat prices that could be skyrocketing and hurting some people, or collapsing and hurting other people, I think most of the movement in wheat prices or commodities prices are attributable to fundamentals. There's a drought in Ukraine, bad weather somewhere else, and then there's a shortage of wheat, and this is reflected immediately in prices, in particular in futures or forward prices. I think speculation or bad behavior by traders can exacerbate these effects to some extent, but I think they essentially, sort of the crest on the wave, and the big wave is really the fundamental forces. And I think the public in general doesn't understand this. Right? Well, another way of saying this is that there are lots of benefits to speculation. Speculation is seen as an evil, but there are also lots of benefits. It has to be regulated. It has to be monitored. Okay, so we need rules, we need information to disclose information about the way people behave. But I think really the root of the problem is really financial education, and this is where perhaps a school like INSEAD can contribute to the greater good.
Yeah, and we can also testify that AXA, with the AXA Research Fund, is trying to look forward above the next semester or year. Maybe a last round of questions, and then we'll close and get to the more informal part of the inauguration. Maybe we'll take the remaining questions, and then you get to pick and choose.
Emmanuel Khalif, Group Risk Management. I have a very basic and concrete question. Do you think that the chair would enable INSEAD to get access to a more enlarged filtration of information with respect to various types of data? I just remember my brother 10 years ago was a graduate of INSEAD, and he took advantage of going to Wharton for a 2-month period, and Wharton at the time was the only one with Harvard to have access to, for instance, tick data in the market. And as a PhD guy at that time, I took advantage of it by downloading a lot of it. And at the time, nobody in France, including Polytechnique, had access to the same amount of data. So it was in 2003.
You've talked about high-frequency trading, which is sits at one end of the financial ecosystem. At the other end, we have long-term investors. Everybody is looking for long-term investors to kind of like stabilize markets. But long-term investors are supposed to be investors who choose not to act on information that affect short-term pricing. Do you have any thoughts on this? Is this irrational to think about long-term investments?
How do you nurture your long-term investors, Emmanuel?
Well, our preferred investors are those who buy stocks on a regular basis with in high quantity. I mean, and we keep it for a long time. And I encourage some of you in the room, if you're not already large investors, please do it. But I mean, most company, if not all company, will tell you we want the good investors and leave the bads to the others, and we want the long-term ones because we don't like volatility and we want the stock price to continue to appreciate in the long term. So, is it rational? Then that's for my correlated colleagues to answer the question. But that's what we're looking for.
Okay, on long-term investors, on quality of data, maybe also. Scarcity of data is certainly an issue.
I mean, the chair will allow to acquire data sets. They're expensive, but I think what's even more scarce in now our research is access to proprietary data that is not public. For example, the data that AXA may have in its treasury office. If Emmanuel is willing to share some of that data, maybe.
I'll leave you Gerald's email.
maybe I should jump in here and say that among the new schemes that the AXA Research Fund has launched for its second tenure, we have what we call joint research initiatives, where we try to find and match AXA teams that would be interested in sharing proprietary data and academics who would be interested in this type of data. Obviously, this is something that doesn't come easy, and there is a trust-building path that has to be trodden. And that's what we try to do. We are in this experiment at this point. What I can say is there is a lot of willingness on both sides, because obviously everyone understands that there is an interest, a mutual interest in that. What we have to hash out is for the trust to be translated in the proper agreements, but mainly in the proper personal relationships, because at the end of the day, that's how these things work. And I suspect you can't wander into Wharton and grab the data in 2 months. They probably made sure that doesn't happen anymore. I hope so anyway. And this is certainly not the type of things that we want to do. So there is a very strong interest here. And you said that, for instance, you can't get access to competencies of traders, but certainly you can if you have proprietary LinkedIn information, for instance. So these also are information that would be useful for that. So I'm sorry, we are running a bit behind schedule, so I propose we close now the panel. I thank our three panelists, and they will be with you at the cocktail, which will be held now in the atrium, which means upstairs. So we'll be very happy to, if you can join us for this part of the event. As I mentioned, the AXA Research Fund is 367, said Gerald, 372 or 73, because we are adding them by the day at this point, notably postdocs. So we'd be happy to get you connected with as many of them as possible. You have brochures in the lobby who showcase most of them or end of their research. And before we all go upstairs, I want to thank you once again for taking part. Thank the teams who organized this and organized the event, but also organized the relationship with INSEAD, because as it's been mentioned, it's been, well, you know, it's been slow at the beginning and then very fast, because I have to say that INSEAD's relationship to the AXA Research Fund has been extremely efficient, and when we have people, institutions that come to us now, we often tell them that maybe they ought to talk to INSEAD to see what a good application is. So really thank you for that. It's been extremely efficient. And again, this is only a beginning. Thank you very much. We'll keep you posted on Twitter, notably. Thank you.
Thank you.
Thank you very much. You're most welcome. I would have come for you from Australia, no problem.
Merci. Thank you very much.